So here we've imported a set of accounts on accrual basis. We've got our trade debtors for both years. We've got our trade creditors for both years, and those are classified accordingly. So here's our trade debtors classified to gross accounts receivable, and trade creditors classified to accounts payable. Now when we open and work with the form, if I want to convert those accrual accounts to cash basis, I can do so through the reconciliation module. Now because those values are classified, you'll see that you've got the options here, and don't forget we're here in the sector where we will be doing something like and you'll see when I turn these on what will happen. So if I go yes, I want to bring prior year accounts receivable to account from a cash perspective. It essentially means I'm going to increase my taxable income because I'm working on the basis that I must have used cash basis tax reporting in the previous year, which means that in the previous year I did something like this. I would have done this in the I would have done this in the previous year, which is what I'm doing in the current year. I'm excluding out the accounts receivable value, which will reduce my taxable income. But don't forget, I'm also factoring for the GST associated with that accounts receivable value. So the previous year I bring the cash in, the cash value in, and for the current year I exclude the accrual value. So obviously I've collected the cash from the accounts receivable in this reporting year from the end of the previous financial year, and I'm excluding the cash value which I haven't yet collected. It's the that's the accounts receivable, haven't yet collected it, so I'm excluding it. I have collected it, I'm including it, and then I can do the exact same opposite with accounts payable. Do you want to adjust out current year's accounts payable? So I go yes, in which case I will be increasing my taxable income. And the same thing down here. Do you want to bring prior year accounts receivable to account? Yes, these would have been paid in the current year. That means the cash went out in the current year. And what we then have is we have essentially represented, because obviously all of your accounts receivable and all of your accounts payable have influenced the profit and loss, because we've factored for those cash or non-cash items. Would be cash on the in from the previous year, cash on the out from the previous year for your payables, and then cash, and then representing the cash we haven't yet collected on the trade debtors at the end of the current year, and representing the cash we haven't yet paid on our accounts payable for the current year. We get to what would be a cash position.